Hey guys, Max here, and this is your daily market update for yesterday, the 10th of February. We had the US CPI data come out, and it was bad, and markets weren't happy. They fell across the board, so we will, of course, cover all of that. Everything to do with inflation today, because that's just a lot to talk about. So what exactly happened in the markets themselves? Well, they fell, and by a decent margin as well. The S&P 500 fell by 1.8%, the Nasdaq fell by 2.1%, the Dow Jones fell by 1.5%, and the Russell 2000 fell by 1.5% as well. Now, all of this was basically because of inflation fears that the inflation that we're seeing isn't subsiding, but it is actually getting worse, and as a result of that, the Federal Reserve is going to have no choice but to raise interest rates and start reducing the size of their balance sheet. They'll start selling off assets, and this will be awful for valuations and asset prices as well. Now, there is just so much more to this than that. We will cover the CPI data in detail in a moment as well, and then cover everything else related, but that is the gist of what really happened. Now, across the rest of the world, the fear in US markets spread as it so often does, and we saw declines in other markets like Europe and the UK, with broad-based indexes falling. Now, outside of equities, there was a lot of volatility, as there always is when inflation data is very high. But in particular, there was a lot of volatility in bond yields or US Treasuries. The US 10-year Treasury rose 11 basis points, and it now sits at 2.05%, its new high for the last 2 years. Now, even more incredible than an 11% basis point move in one day was the US 2-year Treasury, which saw a 26 basis point move in one day, which is a huge change, and its yield now sits at 1.6%, which is again a new high since the onset of the pandemic. Now, oil prices are still very high, with WTI crude oil sitting above $90 a barrel and Brent crude oil just a little bit higher than that. It's also worth noting that the effects on inflation of higher oil prices is susceptible to some lag. And a couple weeks ago, oil prices were sitting closer to $80, so that increase we've seen in price recently isn't necessarily going to have carried over to the previous month of inflation, and we might get it in future months as well as inflation readings keep getting higher. Now, gold prices rose, right? Inflation's high, so gold should go up? Well, wrong. Gold fell for some reason by about 0.5%. Per ounce, it's now sitting just below $1,830. Now, why did gold fall? Christ, I'm really not too sure. Maybe it's because the markets heard from some Fed members who spoke very harshly about spiking interest rates. So there might be a belief going around that gold won't do well in the future because inflation will be adequately fought. Maybe that's the case, maybe not though, maybe it's something else, who knows to be honest. Now, the US dollar actually rose in value, which again seems a bit odd. High inflation readings like this shouldn't really cause the dollar to perform this well, but it did. Now, crypto markets followed the rest of the markets for the most part, with most crypto assets falling as risk on assets in general just took some hits. Bitcoin is sitting close to $43,000 and Ethereum is sitting at about $3,100 at the time of making this video, so down 3%-ish each, and most altcoins were down in the region of 5 to 10%. Now, onto the meat of the news for the day. What was the CPI data itself, and why did it cause this little crash? Well, the headline figures were 7.5% inflation year over year and 0.6% inflation month over month. This was well above the expected levels of 7.2% and 0.4%, so this data was by no means already priced in. Now, for some detail, food prices have risen 7% over the last year, electricity prices are up 10%, household furnishings are up 9%, gasoline is up 40%, and new cars are up 12%. The extent of this inflation is enough to ensure that the average American household will now be spending an additional $300 a month on the exact same things that they were buying last year. Now, once again, I have to mention that statistics are easily manipulated, and to be fair, any measure of inflation is going to be arbitrary to at least some extent. What we see here, though, is far, far worse than that. The way the average price of rent is calculated, for example, has been specifically chosen because it downplays real price changes. The Bureau of Labor Statistics literally go around and ask people how much rent they think they could get for their homes if they put them on the market. Now, this is a mind-numbingly stupid way to go about it, because people who own their own homes don't know how much rent they'd get. They don't rent homes, they tend not to plan on it either, so there is a huge lag in rents rising and these surveys showing that change. The data that the Fed has chosen to use, for example, shows that rents have risen by 4% year over year. Other estimates by organizations that use actual rental data, there'll be a couple links in the description down below for this, put rental increases at something closer to 14% year over year. Now, this is just entirely ignored not only by the Fed, but by the vast majority of news outlets as well. All they care about are the headline figures, not the reality behind the doctored numbers that the Fed shows us. Now, that same sort of thing happens all over the CPI as well, with something called hedonic price adjustment. Now, this, in principle at least, makes sense, and it's the process of adjusting prices for changes in the quality or the amount of materials. For example, 2x4s, the wooden planks, they used to measure 2 inches by 4 inches, but they don't anymore. They're far smaller, and hedonic price adjustment is supposed to account for that. The problem with this is that a lot of it is entirely arbitrary. If you bought a car last year and it had one airbag, but then you bought one this year and it had airbags all over, passenger, driver, side impact, every airbag you can imagine, well, even if the car cost you more money, the CPI data might claim that the car is actually cheaper than it was before because you're getting more car. Now, that is technically correct, but the car is more expensive. You are spending more money, and CPI data is supposed to be a measure of how much the average household spends, not if new cars are a good deal or not. Now, to top it all off, the actual products that are being measured are constantly being changed as well, and often for very arbitrary reasons. In the past, when inflation was very high, beef prices were rising across the US, and so the Fed made the decision to just stop tracking beef prices because they were too expensive for people to afford, and they replaced beef with chicken, a far cheaper meat. Now again, on the surface, for a little bit, this does make some kind of sense, but the result of this change in data is that readings of inflation are just far, far lower, and that gives the government a get-out-of-jail-free card to keep printing money and stealing your hard-earned cash. The reality is here that inflation is far worse than it seems, and it's very complicated to come up with an accurate figure, but thankfully a site called Shadow Stats that I will link in the description down below goes through and recalculates CPI data every month based on how it was done in the past. Last month they had inflation already above 15% according to the way it was measured pre-1980, and after yesterday's results it's probably nearing in on 16% now. Now, despite the manipulated figures, inflation is still at a 4-decade-long high. 7.5% is a big scary number, but most importantly, people in America are directly feeling the effects of this super high inflation, and as a result, they are very unhappy with the current administration. Funnily enough, Biden has been thrown a lifeline by Joe Manchin, who pretty much held Biden's economic inflation agenda off and unexpectedly saved him from himself. Now, ultimately, this inflation data is the reason why stocks fell, but in reality, it had more to do with how some members of the Federal Reserve and how they reacted to the high inflation data. The St. Louis Fed chair, James Bullard, for example, said that over the next 3 Fed meetings, the Fed should raise interest rates by 1%, which would be far, far quicker and stricter than the markets had been expecting. Other people have been calling for a 50 basis point increase in March, which is twice what we were expecting a month or so ago, and that's shaken markets as well. There has also been talk about when the Fed should start reducing its balance sheet, and on this data, that idea has been pushed forward a bit on top of everything else. Previously, it was basically just when the time's right and when we've already risen interest rates by a bit, then we might start selling off some assets. But now strict timeframes are being talked about, and Bullard, for example, wants the process to start in the second quarter of 2022, so not too far away at all. Now, what this means for stocks and risky assets is very simple: a harder environment to make money in, and that will impact valuations. Right off the bat, the fact that inflation is so high and wage inflation is lagging means that people just have less money to spend. The average person is earning 4% more than a year ago, but they have to spend 10% more to buy the same stuff, which means they have to cut back on discretionary spending. This will very directly impact thousands of companies, especially those who aren't really essential at all but are unnecessary luxuries. Then we have the fact that raising interest rates will increase debt obligations for those same people, whether it's credit card debt or payday loans or student loans and mortgages. Repayments will increase across the board, and that means once again that less money is to be spent on everyday items, less money is going to be pumped around the economy, and lesser earnings for businesses. Then we have the fact that when companies want to grow, when they want to expand and reach new targets and produce new products, they need capital to finance all of that, and that means releasing company bonds which will have higher yields and higher costs to service, or taking out loans from banks at higher interest rates. Financing growth becomes more expensive, so we simply see less growth, and those companies and their valuations, especially those who are assumed to grow at 50% every year forever, well, they will take hits. Now, this process goes on and on. The number of things that are directly affected by interest rates are almost too many to mention, but almost all of them will lead to lower asset valuations across the board, especially for companies that are inherently risky. Ultimately, that's the reason why when news like this comes out, the Nasdaq always falls further than the S&P 500, which always falls further than the Dow Jones, simply because of the types of companies that make up each of those indexes. Now finally, to top it all off, we have the impact of interest rates on crypto, Bitcoin, Ethereum, and everything else as well. Now here, no one knows what will happen simply because crypto markets have only existed for just over 10 years and they've never seen a high interest rate environment before, so there is no precedent to look back on. But it is my belief that crypto is a risk-on asset, that it is no longer a niche or an unusual investment, and that as a result of that, it will respond in an almost identical manner to tech stocks. The first reason for this is that most crypto projects are led by companies building ecosystem or technologies or protocols, and very simply, it will become more expensive to build these protocols when interest rates rise, just like it will be more expensive for a company to build a new semiconductor factory. That will impact how much they are able to produce, how much they're able to put out, how quickly they're able to grow and build their code, and that should influence how attractive these coins, these protocols are as investments. Now, secondly, we have the fact that a huge amount of leverage is present in the crypto markets, and while no one knows exactly how much leverage is present, we know it's far more than in most traditional financial markets. Now, put very simply, if you trade crypto on a margin account, that will get more expensive and you'll have to reduce the size of your margin account or maybe even get rid of it altogether, and that will basically mean deflation in the market. Less money trading the assets and prices will fall. Now, there is a belief that Bitcoin is an inflation hedge due to its innate nature. There are 21 million coins and there will never be any more, but just because that sounds nice doesn't mean it's necessarily true. As of yet, Bitcoin behaves as a risk-on speculative asset, not an inflation hedge, and it is certainly possible that it evolves into one in the future, but that isn't the case at the moment. Now, I know there's been a lot of inflation talk today, but I'm afraid there is just a little bit more left over coming from Europe this time. Now, over the last year, the inflation in the US has steadily been a fair bit higher than the inflation in Europe, but the trend has been almost identical. Europe is just a few months behind the US in the same cycle, and the European Central Bank and many governments across Europe as well have been pinning all of their hopes on the idea that inflation will just naturally subside, and that hasn't been going well for them. Generous forecasts from reputable institutions across the continent put inflation at the 7% mark before the second half of 2022, basically where the US is now, and markets are starting to recognize the fact that Europe is probably just going to follow the US. Now that is, in my opinion at least, one of the main reasons European stocks got hurt on this news, because it's basically a precursor of what is to come in a few months' time, and that means higher interest rates are coming to Europe as well, with all the same outcomes that we just talked about. Now, inflation, in my opinion, right now is the number one issue that we're seeing, and unfortunately, many governments around the world seem content to just let it pile up, reduce their debt burden, and let the poorest in society suffer as prices rise. Raising interest rates is a necessity at this point. It has to happen, and it has to happen as quickly as possible. Now, every time we talk about interest rates rising as a result of high inflation, I see the same argument down below in the comments, that rising prices are directly as a result of supply-side shocks and that demand has no factor in these prices, so raising interest rates won't help. But there is a huge problem with this idea, and it's the fact that prices are never a factor of supply or demand, but always both. Very simply, demand right now is unprecedented because capital is so ridiculously cheap. By making that capital more expensive, people's spending habits will be forced to change, demand will fall, and price inflation will subside in time. Now, the other argument I see pop up for why we should keep interest rates at zero is because people want their stock portfolios to stay high. And to that, all I can say is that you're not actually rich and your assets aren't actually worth what you think they are. The Federal Reserve has just been inflating their values and manipulating the markets for 2 full years, deluding you into thinking that this is normal, that the S&P 500 is supposed to rise by 30% a year every year while macro conditions are actually worsening. Now that isn't normal, it isn't sustainable, and it has to end at some point, and the sooner it ends, the lesser the pain will be, but the more it drags on, the worse the end result. Now, I will be back tomorrow, of course. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up. You don't have to buy anything. You don't have to hand over any card information. So if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.